In today's episode of the Daily Brief, I'll talk about two stories. I first talk about the comeback that public sector banks have made over the past decade. I then discuss how Reliance's biggest deal in its history can change geopolitical dynamics for India. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to other news channels. I am your host, Kashish Kapoor. Today is Monday, 16th of December. You can find us on Spotify, Apple Podcast, or wherever you consume your podcast. The Daily Brief is also available in Hindi. And if you like reading instead of watching or listening, you can sign up for our No Spam newsletter for a quick rundown. All the links are in the show notes. So let's begin. When banks give out loans to borrowers, they know not everyone will pay back. Some loans can go bad, and when they do, they are called non-performing asset, that is an NPA. Banks have been in the business of lending long enough to gauge what the odds of this happening are. So they try to preempt this. How? By providing for them in advance, which is just a fancy way of saying that they set aside a portion of their profits for this. Now, these bad loans still show up in the balance sheet of the banks. Just that banks are now financially prepared for the worst case scenario. During such extreme cases, banks decide to write off these loans from their books. This means that now these loans don't show up in their balance sheets anymore, but they still continue their recovery efforts and borrowers are still liable to pay up. This write-off number for the public sector banks came out recently. It was 42,000 crores for the first half of FY25. It was 1.14 lakh crores in FY24 and 1.18 lakh crores in FY23. For the 3 years before that, it was combined 4.26 lakh crores. Now, if you look clearly, there's a clear trend here. The bad loans being written off by public sector banks have been slowly and steadily going down. Moreover, against the 7 lakh crores of bad debt written off since FY20, 5 lakh crore rupees have also been recovered, which is roughly 70% of that amount. For FY25, this was around 95%. So not only are public sector banks writing off lesser and lesser bad loans incrementally, the proportion of recovery has also been higher and higher. This has resulted in their credit cost also going down consistently. Now, what does this mean? It shows that the asset quality for these public sector banks is getting better. But this is a result of some really bad things that happened almost a decade ago, and then all the firefighting that RBI and government did to get things back on track. Let us get some historic context, starting with a massive reality check called the Asset Quality Review, AQR. Back in 2015, the Reserve Bank of India, under Governor Raghuram Rajan, decided to take a long, hard look at the books of Indian banks. Why? Because whispers of bad loans were growing louder, especially in the wholesale lending side. This is where loans are given to big corporations and not retail like you and me. Banks had been dishing out loans like candy during the economic boom of 2006 and 8, but not all those loans were wise choices. Big corporate borrowers, think names like Kingfisher Airlines, Bhushan Steel and Amtech Auto, were defaulting left, right and center. These were loans banks had classified as fine, but in reality, they were rotting. The AQR brought everything to light. To give you some idea, bad loans in the Indian banking system jumped 80% in FY16, according to the RBI data, mainly on account of this AQR. To fix the mess, the government rolled out 4R strategy. First, recognition. Admit the problem. The AQR forced banks to recognize bad loans instead of hiding them. Number 2, resolution. Now was the time to resolve for all these bad loans. Tools like the Insolvency and Bankruptcy Code came into play, ensuring time-bound resolution of stressed assets. Number 3, recapitalization. Public sector banks needed money to survive. The government infused 3.1 lakh crore rupees to recapitalize these public sector banks from 2016-17 to 2020-21. And finally, reforms. Reform the system to prevent a repeat of this mess. The government didn't just throw money at the problem. It pushed for meaningful reforms. Here's a quick rundown of key changes in a chronological order. First, IBC. In 2016, the Insolvency and Bankruptcy Code ensured faster resolution of bad loans by putting banks in charge and introducing a time-bound framework for resolving stressed assets. The average recovery rate through IBC was in excess of 40% versus an average recovery rate of 26% through prior means. IBC also reduced resolution time from 4.3 years to 460 days in 2021 and improved India's ease of doing business rankings. Number 2 was Bank Board Bureau in 2016. To professionalize public sector banks' governance, the BBB was set up to recommend top appointments, evaluate the performance of bank boards, and guide reforms in governance practices. Number 3, amendments to SARFAESI Act in 2018. The government enhanced the powers under the securitization and reconstruction of financial assets and enforcement of securities and trust, that's SARFAESI Act, to simplify asset recovery processes, empower asset reconstruction companies, that is ARCs, and expand the Act's scope to cover NBFCs with assets more than 100 crores. Number 4 was creating a public credit registry in 2021. A centralized database was created to track borrowers' credit histories, reducing the risk of loan frauds and preventing practices like evergreening of loans. Next, National Asset Reconstruction Company Limited was established in 2021. Also called the Bad Bank, NARCL was established to focus on resolving high-value stressed assets. Alongside India Debt Resolution Company Limited, it aimed to clean up the balance sheets of banks and accelerate recoveries. Fast forward to today, and PSBs have come a long way. According to a Motilal Oswal report, gross NPAs of PSBs dropped to 5.2% in FY23, down from a high of 14.6% in FY18. The reforms worked, and asset quality is even better than pre-AQR levels. Great, right? But here's the catch. Stability doesn't mean safety. Now, the spotlight is shifting to unsecured retail lending. You say credit cards, personal loans, and the like. With booming demand for such loans, there's a growing risk of defaults. If banks aren't careful, this could spiral into another credit cycle, this time fueled by retail loans instead of corporate lending. Now, on to the next story. The next story is as much about economics as it is about geopolitics. Reliance Industries has signed the biggest energy deal ever between India and Russia with Rosneft. The deal will see Reliance buying 5 lakh barrels of crude oil every day for $13 billion a year over the next 10 years. To put that in perspective, India uses around 50 lakh barrels of oil per day. So this deal covers 8 to 10% of country's daily oil needs. That's a big chunk. The oil will be refined at Reliance Jamnagar complex and turned into fuels like petrol and diesel, as well as petrochemicals used in products like plastics and synthetic fibers. This isn't just a big business move. It's critical for India's energy security and economy. But this deal didn't just happen overnight. It's the result of events that have been unfolding for years. Let's look back at how we got here. First, rewind to February 2022, when the Russia-Ukraine war began. Western sanctions against Russia hit hard, particularly in form of measures that prohibit the purchase, import, and transfer of seaborne crude oil and certain petroleum products from Russia to the European Union. These restrictions cut Russia off from a major market, pushing its oil to buyers willing to ignore geopolitical pressures. This is where India came in. Before 2022, India barely imported oil from Russia. But now, 40% of India's crude oil comes from Russia, with imports reaching nearly 20 lakh barrels per day in 2024. Why? The simple reason is price. Russian oil is cheaper. When sanctions were first imposed, Russian oil was discounted by as much as $30 per barrel compared to oil from the Middle East. But as demand from countries like India and China grew, the discount shrank. Today, the discount is around $3 to $4 per barrel, but it's still enough to save India money and reduce its import bill. The US tried to stop Russian exports by banning imports and targeting the shipping networks that carried Russian crude. They imposed huge sanctions on Russia's largest state-owned shipping company and other firms involved in transporting oil. Reliance, like many others, stopped using the sanctioned ships to avoid the trouble. In response, Russia built a shadow fleet, a group of older ships bought or leased to operate outside the Western control. These ships help Russia keep exporting oil even under sanctions. While risky, this fleet has allowed buyers like Reliance to keep importing Russian oil without directly breaking any rules. India, for its part, has been determined to keep buying oil at a discount, and Reliance has led the way. Earlier this year, Reliance tested waters with a smaller deal of 30 lakh barrels a month from Rosneft. And now the big one has come. That's 5 lakh barrels per day. It happened right after the BRICS summit, highlighting growing ties between India and Russia. But let's not forget, oil isn't just about business. It's deeply tied to global politics. By strengthening ties with Russia, India is showing its willingness to focus on its own energy needs, even if it means facing pressure from the West. Deals like this can also have political consequences that are very hard to predict. In the end, this deal shows how complicated global oil politics can actually be. From sanctions on Russia to India's growing imports, every move is a part of a bigger game. For Reliance, it's a smart business win. For India, it's a step towards energy security. But beyond the numbers, there are always political motives at play, and we may never know the full story. Now, moving on to the tidbits for the day. First, SEBI has proposed a framework allowing retail investors to participate in algorithmic trading, requiring broker approval for algorithms and unique tags for algo orders. Algos will be categorized into execution, white box, and black box types. Brokers must identify algo orders and work with approved providers. Public comments are due by January 3, 2025. Number two, Reliance Retail faced challenges in 2024 due to weak demand and rising competition. Jeffries suggested that company may need to focus on quick commerce given its omni-channel ambition and past investment in Dunzo. Reports indicate that Reliance may target a 30-minute delivery service as quick commerce continues to grow in major cities. Number three, Blinkit has launched Bistro, a 10-minute food delivery service competing with Zepto Cafe, Swiggy's Bolt, and other quick commerce platforms. The app offers a variety of food and beverages and is currently available in parts of Gurugram. And that's it for today. I'm your host Kashish Kapoor. This was the Daily Brief, and I'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.